presentation contains current opinions of Mojo Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor, and are subject to change. Nothing in this presentation should be considered investment advice. We make no assurance that Mojo's opinions or illustrations will accurately predict future prices or financial markets. In no event is past performance a guarantee of future performance. A detailed disclosure can be found at the end of the presentation. And now here's Mo.
Hello everyone, and welcome to the Compak Market Wrap YouTube update for December the 4th, 2023. I'm Mo Ansari, President of Compak Asset Management, and thank you for joining me today. Again, don't forget to go to the compak.com/media page to get all of this information. You can listen to my weekly podcast. You can download the mobile app. That's the Market Wrap app that you can get the podcast directly downloaded to your phone. You can register for upcoming events, subscribe to the YouTube, iTunes podcast, and don't forget the weekly Market Minute. It's a one-pager. Just gives you an update on the markets, and you can always schedule a call with us. All of that information, all of it is free at compak.com/media. Let's start with the markets. For the week, the market was up 0.83% on the week, and for the year, up 21.5%. It was just a wonderful, wonderful week, wonderful month that we had in November, one of the best months we've had in nearly a year and a half. Dow Jones was up nearly 2.6%, going to a new high. The Russell was up 3.12%. And those are the things that I really like to see, the broadening of the market, not just the Magnificent Seven in technology, but we're seeing the rest of the market. The NASDAQ was only up 0.41% for the week. So we're seeing the broadening. Year-to-date, technology is leading, but now you can see real estate had a really good week this past week. And the reason was interest rates continue to come down. The 10 years down to about 4.25, down from 5%. So that's nearly 0.75% decline in the rates already, even though the Fed has not lowered rates, obviously, but the market is anticipating a decline in rates. Materials, industrials, financials, consumer discretionary, all were the top, and we saw technology at the bottom. So that is sort of a flip from what we've seen all year long. Also, we saw the interest rates continue to decline. The 10-year Treasury at 4.22 compared to a week earlier at 4.47. And so now we're just about where we were, just about a half a point higher than where we were a year ago. So rates have started to moderate, and that is going to be a big factor, especially for the 493 companies in the S&P, and the small caps are going to benefit most from the interest rate declines. Looking at oil, a year ago, it was $80 a barrel. It's $76.06. So it continues to come down, and that takes away the inflationary pressure. Plus, the two largest components for the CPI, the Consumer Price Index, are autos and shelter. Both of them continue to decline. The question is, will the market continue? I think we're going to get some kind of little bit of a pullback this week, waiting for the Fed next week. Once the Fed comes out and says, okay, we're done raising interest rates, but we're not going to lower interest rates anytime soon. So they've gone from, we're going to keep raising interest rates, though we're not going to lower interest rates. So I believe they're going to do it faster than what everybody anticipates. Right now, there's a 92% probability that the Fed will decrease rates by June of next year. I feel that is going to move forward as the economy continues to slow. You can see that bear market declines, here they are going back to the 1980s, about 43 years back. You can see how many days it took us to get to a new all-time high, 487, 485. In 1990, it only took 180, but in March of 2000, it took 1,800 days. In October of 2007, when the bear market started, it took us 1,300. But those were structural problems in the economy, where we saw the tech bubble burst, where we saw the real estate bubble burst. We have not seen that. The COVID was one of the shortest. Now we're 481 days from the all-time high that we made at the beginning of last year. So we're about average from where we've been looking at this. So it has been a long time. We don't have the structural problems. We feel that the market is poised to head towards the 48.18 high that we made at the beginning of 2018. But there is one little resistance area that we need to overcome, and I'll show that to you when you take a look at the charts. Last week, we got new home sales, 679,000. Pending home sales, 1.1%, headline inflation 3%, core inflation 3.5%. So we're continue to come down, but the easy work has been done. The 9% to 3% decline, all the way down 6% decline in inflation, but the rest is going to take some time, but it is on the right track. This week we got the job openings report, the JOLTS report as it's called. We get the services PMI, and the big report on Friday is going to be the employment report. I think that could get a bounce. We could get a stronger than expected unemployment report because all the UAW workers, the auto workers coming back to work, that could distort this month's number. Looking at the technicals, we're looking at 4607. That is the high that we made in July. We got last week to 4599. Couldn't quite get above this. If we can get above this and get above 4600, then the target, the Fibonacci target from the previous high, comes to about 4680 to 4730 to about 4800 or 4700 is where we could get to once we get the Santa Claus rally and once we get above 4600. Support now is at the 20-day moving average, which is about 4500. Then below that we have the 50-day, but I think somewhere if we do get a decline right about to 4500, and we're about 45, 46 now, somewhere around there could be a good buying opportunity to set up for the next rally. Looking at the weekly charts, we still are in this A, B, C corrective mode. It's not 1, 2, or 3 yet, but once we get above the 46, this 4607, this number, then the next resistance on the weekly charts is the all-time high of 4818. If we can get above that, then we're looking at 5,000, but that might be a year and a half away from where we are now. The NASDAQ, on the other hand, has exceeded the high that we set last July. We got above that last week. We are pulling back now. This is wave 1, 2, and we're in wave 3. We should get a wave 4 pullback. Could take us down to about 14,000. We're trading about 14,150 today. Once we get decisively above 14,500, then we're looking at the long-term target, which comes in about 15,400 for the NASDAQ on the daily charts. On the weekly charts, we're still looking at 14,008 to 15,000. That is the projection from this. But the long-term projection obviously is much, much higher. But once we have to get above this year's high, which we have, then we're heading towards last year's all-time high. Interest rates, as I mentioned, 5% was the target. We hit that. We're starting to decline. Next support is 4%, but we could get a bounce here a little bit in rates before we come back down again. Oil market continues to get weaker and weaker and weaker. Support now is around $72 a barrel. Resistance at the 200-day, which is about $78 a barrel. Gold had a great day, making a new all-time high today, but then it reversed down as the market came down. I think we're in the wave 4 pullback, which could take us down, back down to about 2,000. We're 2,048 today as far as the gold is concerned, but I think long-term gold is also headed higher. Those are my thoughts. Those are my views. Thank you again for joining us. Again, I will be back with you next week. If you want information, what we do, how we do it at Compak, just go to compak.com and you can set up an appointment. We will be more than happy to devise a roadmap for your financial future. Have a wonderful week, and I will see you next week.
This presentation contains the current views and opinions of Mojo Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor. The views expressed are current only as of the date of this presentation and are subject to change. Nothing in this presentation should be considered investment advice, and nothing is personalized to any investor's individual circumstances. Compak Asset Management offers investment advice only after entering into an investment advisory agreement and gathering client-specific information about goals, objectives, financial status, and risk tolerance. This presentation uses terminology associated with technical analysis and provides charts to illustrate some of the concepts discussed. Technical analysis is a security analysis method with the goal of forecasting the direction of prices of securities or market indices through the study of past market data, primarily price and volume. We make no assurance that past performance or the use of technical analysis will accurately predict future prices. Further, a risk of technical analysis is that overfocus on historical patterns could lead to ignoring or downplaying security-specific concerns, overall market or sector concerns, or other factors because we assume inaccurately that historical patterns will repeat themselves. In no event is past performance a guarantee of future performance.